Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to talk about a topic that many of you have requested, which is more advanced strategies and talking about how you can leverage your capital using limited risk. And we're going to cover the full gamut from beginner strategies all the way through the most advanced strategies. And we're going to talk a little bit about the different levels of leverage that you can get and what the different trade-offs that you have with each one. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off by just talking a little bit about the introduction of leverage and kind of what leverage means, what is important for you to pay attention to, and understanding the different trade-offs that you have to make when you're thinking about leverage. Then we're going to go through the different levels of leverage that you can get using options. We're going to go from beginner to advanced, starting from the very beginning, long calls, the simplest option strategy that almost everyone here is probably at least familiar with, talking about how that improves your leverage by moving over to debit spreads. And then we're going to talk about variations of a debit spread, which is using time spreads to further potentially reduce your risk and increase your leverage, but kind of what trade-offs you make when you're trading in time spreads. And lastly, we'll talk about butterfly spreads, where you can get maximum leverage, but also again, at the same time, when you get that maximum leverage, there are some trade-offs with that. And then at the end, we'll try to go through some examples and open this up for Q&A. But once again, I want to thank all of the members for submitting your feedback during our recent events survey. We've incorporated some of those, some of your feedback in today's session. Many of you asked for more advanced strategies, so we want to cover those in the form of time spreads and butterfly spreads, and we'll continue to do that as we go along. But during today's session, the primary thing that I want to help investors walk away from today's session is a clear understanding as to what are the various option strategies that can help provide leverage and how do they really differ from each other, so that you understand what the trade-offs for each strategy is going to be. So let's talk first about trading with leverage, because leverage is this word that it has a double-edged sword for most investors. You know, you think of leverage as something that can really provide gains or large gains in your favor if you get the directional view right, but then can also really hurt you and potentially blow up your account if you get it wrong. So, you know, that's leverage in the traditional sense, right? If you're trading Forex, you know, where you can get up to 50 times leverage. If you're trading futures, where you can get anywhere from 3 to 20 times leverage. Or if you're trading options, the difference about options leverage is the fact that options leverage provides you with a lot of flexibility. It's not like, futures or Forex leverage where you kind of, you have a set amount of leverage and you choose to use it or not. With options, you have a lot more flexibility, and more importantly, you have access to leverage with limited risk, something that the other markets or other asset classes do not provide you with. So today, we really want to spend some time understanding these risks and how we can utilize options to our advantage to limit those risks. That's the first thing. The second thing we want to understand is how much leverage are we actually getting when we're trading options. That's a leverage factor. So we'll go through a few examples and show you the different levels of leverage that you're actually receiving with different option strategies, so you can get a sense for which strategies have high amount of leverage, which strategies have lower amounts of leverage, and what the trade-offs are for each one. And the most important part is really the trade-offs. Each strategy has their pros and cons, and you have to understand what those pros and cons are to help you determine which strategy is suitable for you. So today we're going to go from beginner to advanced to hopefully give you a better sense for the different spectrum, the different range of leverage factors that you can receive, and how creative you really can get with options. And as you get to the more advanced strategies, what you're really adding on is creativity to how to leverage these options to your advantage to gain leverage with limited risk. And this is by no means an exhaustive list. This is just scratching the surface, because you can get far more creative and far more complex if you want to, but hopefully today will give you kind of the building blocks, the foundation that you need to continue your options trading into more advanced strategies. So I'm going to start off with the simple option strategy that most of us are familiar with. I'm going to use Johnson & Johnson as an example, a strong stock that recently had a bit of a pullback here, potentially this is the type of stock that you're looking to apply some leverage to. You think it's a fairly expensive stock, so you might want to apply some leverage to be more capital efficient. And perhaps this is a stock that you think is going to continue its move higher. So to buy 100 shares of this stock would cost you $17,461. So let's talk a little bit about buying a call option. So we're generally familiar with this strategy. It's a strategy that gives you unlimited reward in exchange for limited risk. And in this particular case, if I'm looking at the November 175 calls, which are the November at the money call option, this is costing me about $5.15 or $515 per contract. So just to first calculate the first step, the amount of leverage we're receiving. So we're controlling $17,460 with just $515. That implies a leverage factor of about 34 times leverage when you're looking at a call option like that. So hopefully that just helps put this thing into perspective as we look for other strategies. And this is a strategy that will risk a total of $515 or $5.50 per share out of the $174. That's about 3% of the underlying stock that we're risking on this particular trade. So that's the trade-off that you're making, right? You're risking 3% of the stock in exchange for unlimited reward. And a lot of investors will say, a lot of you that are viewing will say, that sounds like a great idea, right? Why not risk only 3% to try to make unlimited gains? And I'm controlling a $17,000 position for just $515. And this is what on paper is most attractive about options, this asymmetrical risk with limited risk. Your max reward is unlimited. The challenge here with this particular strategy is the fact that the break-even cost is $180.15. So the stock has to rally about 3.1% over between now and November just for the strategy to break even. The stock has to move beyond $180.15 for you to make a profit. At $118 at $180.15, you're just breaking even. You're not even making a profit. So you have to believe the stock is going to move beyond $180. And that's not always the case where every day you think the stock is going to make a big move. So the trade-off that you have with this strategy, with this amount of leverage, is the fact that you have a very low probability of profit, about 32% probability of profit. That's not particularly strong here in terms of a chance of being profitable on this particular trade, but the trade-off that you're making here is that you're risking a relatively small amount of capital in exchange for an unlimited amount of potential gain. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Now, again, this is just the beginning. This is just setting this up, right? This is the beginner leverage strategy. Now, there are many, I would say, trade-offs, if you will, and predominantly it's because the stock has to make a big move before you're profitable, and it has a relatively low probability of profit that isn't particularly attractive about this strategy. So there are some advancements that we can make as we learn more about options trading to improve this. And the first advancement that we learn is creating a debit spread. A debit spread is doing the same thing that we're doing before. We're still buying the November 175. We have the exact same setup where we think the stock is going to rally. But instead of just buying the 175 call option for $515 as we did before, we're now also going to sell a 185 call against it. And the theory here is the fact that why should I pay for unlimited upside if I don't think the stock is going to reach 200, 250, 300 by the November expiration? There's no reason for me to pay for it. So options give me the flexibility, and this is the flexibility I was referring to earlier. Options give me the flexibility of selling off some of that upside in exchange for upside premium. So here, what I'm doing is I'm selling the 185 calls. So if we just do a little bit of math, 515 minus the $352 that's now the spread is costing, I'm actually collecting about $1.63 to sell the November 185 calls. And what this $1.63 that I collect allows me to do is that now I'm controlling the same $17,467 for just $352. This increases my leverage to 50 times leverage. Before I had 34 times leverage. Now I have 50 times leverage. So by selling that premium, I'm going to collect some money. That's going to reduce my overall risk. It's going to reduce the capital that I need to get into the trade. And that increases my leverage. So what it does is that it decreases my risk. Before I was risking about 3% of the underlying stock's value. Now I'm only risking 2% of the underlying stock's value. But there is a trade-off here, right? The trade-off is the fact that I have limited rewards now. If the stock really takes off, I don't participate on that. Above 185, I'm capped in the amount of money that I can make, but it is capped at $6.48, which is about 3.7% of the stock's value. So I'm getting almost about a 2-to-1 risk to reward ratio on this particular trade. And what it does is it improves my break-even cost, because by reducing the cost of the trade, the stock doesn't have to move as far before I'm profitable, only has to move to 178.5, which now the stock only has to move about 2.2% before the strategy is profitable. Before, in the previous example, in the long calls, the stock had to move over 3% before the strategy is profitable. So here, because the stock doesn't need to move as far, I now have a higher probability of profit. So when you use a debit spread, you're getting a bit more creative. You're selling some premium for an event that you don't think is, or you think is less likely to happen. You reduce your risk, you increase your leverage, you decrease your break-even price, so you improve your probability of profit. And generally speaking, when you use a strategy like this, you'll tend to find that when the option that you sell should roughly reduce the cost of the long call by about 15 to 20% in exchange for limiting that upside. So you're going to reduce your risk by roughly 15 to 20% in exchange for reduced risk and a limited upside. Does that make sense? Please type 2 into the chat window if that makes sense to you. Okay, so these are two strategies that we trade very commonly. These are two strategies, for those of you that have been with us for a while, should be fairly familiar with this. So now let's take this to the next step, right? How can we take this idea of selling premium to reduce our risk perhaps even a little further? And that's where we get to time spreads. So again, we're going to do the same thing. We have a Johnson & Johnson stock that we think is going to move higher here. We're going to do the same thing. We're still going to buy the November 175 calls. That costs us $5.15, just like in our first example. But instead of selling a November call against it, what we're going to do now is we're going to sell an October call against it. Now, we're going to bring in a little less premium for it because the October call options are going to collect less premium. So in this particular case, let's say I sell the October 180 calls. That's going to cost me a net debit of $438. So let's just do a little math here again. $515, which is the cost of the long call, minus $438, which is the cost of this strategy, means that when I sell the October 2021 call options, I'm collecting a total of 77 cents. Now, some people will say, why would you want to collect less money, right? Before I was collecting about $1.60 something by selling the November 185s. Why do I only want to collect 77 cents for the October 1st? Well, this comes down to a few things. One, because in a time spread, I can potentially sell multiple calls before the call option expires, before the long call option expires. And between the October, the November, and maybe I might be able to sell even, because this is October 1st, right? If the October 1st options expire, I can sell a November 1st option. And then when the November 1st option expires, I can potentially sell a November 19th option. So I can really potentially sell 3 options between now and the expiration of the call option, of the long call option. And the idea here is that you can potentially eke out a few more cents, a few extra 10, 15, 30 cents on this type of strategy versus if I sell just the November 185 call, I only have basically one chance where I've reduced the cost here by about $1.60 or so. Here, if I'm collecting 77 cents every single month, I can potentially maybe eke out $2 in premium by selling calls against it more frequently because shorter dated options have slightly elevated premium. They're going to decay at a faster rate. So it's really taking advantage of the fact that shorter dated options decay faster. And if I sell short dated options more frequently, I can collect more premium over the lifetime than I would if I sold a single, let's say 2 or 3 month option. Does that make sense, everyone? Please type 3 free, if that makes sense to you. And someone made a point here. You can sell weeklies to make even more premium. Well, this is the trade-off that you make with diagonal spreads, right? Is the fact that when you're selling more frequent options, you do run the risk that if the stock takes off in the week that you sold, that you will start to underperform if it goes above the strike price. So this is the trade-off that you have to make when you're getting more premium, is that you have to decide the strike price more frequently as to where you think the stock will be below between now and the expiration date. And the more frequently you sell, the more frequently you have to make that decision, the more frequently you may have to make adjustments, the more frequently you may have to buy back that call option at a loss, okay? So that's really kind of where you have to find the balance between what you are comfortable with and the amount of work that it takes to manage these types of trades. So that's why I tend to find that it doesn't ever make sense to sell weekly options, because then you have to constantly adjust these trades every single week. Versus if you sell a monthly option, you can make adjustments once a month. They're far more reasonable, in my opinion. But so let's go back to this, right? So total risk here is $4.38. So this is in between the call option and the debit spread. We're risking $4.38. That's about 2.5% of the stock's value. The max reward here, this is the part that's a little tricky, because when we look at max reward, we cannot really calculate the max reward of the total strategy. We can only calculate the max reward of the strategy at the first expiration. So this is really where it's tricky, because you have to think about what can happen at the first expiration. The stock can be above 180 at expiration, or it could be below 180. So the max reward here of a 1.8% is actually not accurate. It's 1.8% at the first expiration. You have a larger max reward post the first expiration, but we can't model what's going to happen after the first expiration, because we don't know where the stock's going to be at the first expiration in order to do that. But the one thing that this strategy does provide that is very unique is the fact that the break-even cost, and this is just what it came out to be for this particular trade. It doesn't happen always the case, but you'll generally tend to find that the break-even cost is very close to the current price. What that means is that if the stock doesn't really move between now and October 1st, in the previous two strategies, if you bought a call option or if you bought a call spread, both of these strategies, if the stock doesn't move over the next month or so, you're going to see some losses. Versus if you trade a diagonal spread, generally you're not going to see any huge losses. Sometimes you might even see a small gain depending on how much premium the trade costs. So even if the stock makes a small move, you'll see a profit on this particular trade. So it has a very high probability of profit. When you trade a diagonal spread like this, usually you have a probability of profit of about 50% between now and the expiration of the first option. Again, the trade-off here is the fact that if the stock does take off substantially, instead of really having that unlimited gains as you do with the call option, or some limited gains with a debit spread, as the stock keeps going higher and higher, you actually see potentially some losses, but certainly start to see a reduction in how much gains that you have. So this is kind of sometimes could be a little disheartening, right? Where you really got the directional view right and the stock takes off, but now you actually see a smaller gain as a result of it. So that's the trade-off. So that's why I'm not a big fan of selling weekly options on this, because you really run that risk every single week where the stock takes off, for whatever reason, maybe news or something related that's out of your control. And instead of seeing a big gain out of that, you actually start to see a smaller gain as a result of that. So those are some of the challenges that you have with diagonal spreads, but they do potentially provide you with those, short-term, higher probability of profit, and in the long run, potentially higher returns, because you can further reduce your risk with this particular trade. Does that make sense? Please type 4 into the chat window if that makes sense to you. So this strategy is a little bit more complicated and actually takes quite a bit of time to learn and adjust. So this is really the type of strategy, if you've never traded before, I recommend that you paper trade first, go through a few expirations, or at least have plenty of experience trading cover calls, because it's similar to selling a cover call, just that you're replacing the long stock leg with the long option leg. But overall, the management of the options that you're selling is similar to selling a covered call. Okay. So that is, a different leverage strategy, if you will, that allows you to sell some premium against the call that you're buying, and by selling it more frequently, you can collect more options. So let's talk about the last strategy, trading a butterfly. This is really taking the concept of a debit spread kind of and putting it on steroids. And most people think of butterflies as a neutral strategy. Based on our back test, butterflies are not a great neutral strategy. They simply do not work as a neutral strategy. First of all, there isn't a good indicator that tells you the stock's not going to move in the next few weeks, right? There isn't like a technical indicator that you can use to say, now I think in the next few weeks, the stock's not going to move. That just simply doesn't exist. So you don't really have a good timing for it. The only strategy that I tend to find is that, after the stock makes a big move to the upside or big move to the downside, usually after those big moves, the stock tends to consolidate for a time. But those are also extremely difficult to time. And it's not really the best strategy to trade it with. Perhaps you might be better off using an iron condor than a butterfly. So what butterflies are far better at is actually more of a directional trade. And most people don't think of butterflies as directional trade, but let me walk you through this. The idea is to do the same thing. We're still going to buy a 175 call. And notice here, I'm using October 1st because butterflies, we tend to use a shorter dated expiration for butterflies, but we're still going to buy the 175 call option like we did before. But like I said before, we don't think the stock's going to go to infinity, right? So why should we pay for it? So first thing what we're going to do is we're going to sell, let's say, a 180 call against it. And what that does is it brings the risk from something that looks like this to something that looks like this. Now, you might say to yourself, well, debit spread, if I'm selling one contract at 180, why can't I sell two contracts at 80 and bring in double of the premium? And that's the concept of a butterfly, is you're basically selling double the premium. But when you sell double the premium, guess what? You have unlimited risk to the downside now. So instead of saying that, okay, well, I don't want unlimited risk to the downside if the stock really takes off. So what I can do is I can buy this really cheap, far out of the money call option that will limit my risk to the upside as well. So if the stock really takes off, I don't have unlimited risk, especially if you do this in a stock like GameStop, right? You want to make sure that even if the stock does take off substantially, that you don't have unlimited risk. So what you do here is now what you're able to do is you're basically able to bring in twice the amount of premium, which is going to further reduce the cost of buying that 175 call. And you really have to buy this extremely cheap out of the money call option that costs you next to nothing anyway to limit your risk. And what you have here, as you can see here, is I'm controlling the same $17,000 position for only $118. That significantly increases my leverage factor here to 149 times. So remember, the other ones we're looking at 40 to 50 times leverage. Here I'm looking about 150 times leverage because I'm controlling this position for such a small fraction of the capital. And this is the type of strategy that we do see trade a lot in things like Amazon and Tesla, where people may not even have the premium to buy a single contract of the options. They trade some of these butterflies that have a very low premiums from a percentage perspective, because here, as you can see, I'm only risking 0.67% of the stock's value. I have a max reward of 2.18%, and the risk to reward ratio is very high, right? I'm risking 118 to make 382. That's over 3-to-1 risk to reward ratio on a butterfly like this. But it does have a fairly high break-even point, right? But that's what you're trading off when you have a really strong risk to reward ratio, is you have a very high break-even point, and you have a relatively low probability of profit. And what you're basically doing here, when you think about a butterfly, is that you make the most money at the point of which you sold the two options. In this particular case, I sold two options at 180. So this is really where you have to be careful and think about, where do you sell these options? And the general consensus based on back testing here for where do you choose the strike price to sell those two options at is going to be the one standard deviation move. So whatever the one standard deviation move for the options expiration that you are selling, selling, that is the strike price that you should be selling the tip of the butterfly at. And the idea is that if you are right on the directional view, it's most likely that the stock will reach roughly the 1 standard deviation move. It's less likely to move substantially above it, and it's less likely to be substantially below it. You want to be somewhere around that 1 standard deviation move, because the options premiums are implying that the stock can move on average about this much. So that's why you should use those statistics to your favor in order at selecting the premiums on that butterfly spread. But these are the types of strategies that have, again, low probability of profit, because you have to basically thread the needle. The stock has to basically reach 180 and not go too much further above it or too much further below it. It has to kind of end up around 180. And if you get it right, you can really have a very strong risk to reward ratio. But if it goes too far above, you're going to see some losses. If it goes too far below, you're going to see some losses as well. But if you do get it right, the risk to reward ratio is extremely strong, and you're risking very small amounts of capital to put on this trade. So especially for, investors with small accounts, sometimes this is a better, I wouldn't say it's a better way. It's a way for smaller accounts to take risk using options without limiting you to very, very small price stocks. So someone even with a $2,000-$3,000 account can potentially trade a Johnson & Johnson directional view using something like a butterfly spread. So let's just take a quick look at OptionsPlay. I just want to walk you through some of these trades. You can use the OptionsPlay tool to help you set up all of these trades. We have the call option, which I will change to the November 175s. We'll look at the November 170, 175, 180 call spread. And then what we can do is we can look at the call butterfly. Now, when you're trading these, what you generally want to do is when you're trading butterflies, if you're trading a bullish butterfly, you want to use a call butterfly. If you're trading a bearish trade, you want to use a put butterfly. Generally, you don't want to use iron butterflies for a directional view because you have a higher assignment risk, right? So if you're bullish, call butterflies. If you're bearish, put butterflies. And again, what we do here is we use the trading range simulator to look at, for the October 1st expiration, what is the 1 standard deviation move? And as you can see, the October 1st 1 standard deviation move is around $180.68. That's why we are choosing to sell the 180 strike price on the call butterfly. Now, in this particular case, we don't really have a lot of choice, right? As you can see, the strike prices are $5 apart. I can buy the 175s, I can sell the 180s, and I can buy the 185s. So again, what I'm doing is I'm paying $2.38 for the October 1st 175s, and then I'm going to sell 2 contracts of the 180s, which is going to bring in 68 cents each. So about $1.30, close to $1.40 for the 2 premiums. And as you can see, that's going to offset most of the premium here. And I only have to pay 30 cents to buy that really far out of the money 185 call that caps my risk. So I don't have unlimited risk to the downside. If I don't buy that, as you can see, I have unlimited risk to the downside. So my risk becomes unlimited if I do not buy that 185. So I definitely want to buy that 185 so that I can offset my risk on this particular trade. But as you can see here, the amount of risk that I'm trading on each one of these is vastly different. The butterfly, far less risk, but similar probability of profit as buying the call option. The call option just has a different risk to reward where I'm risking $500, but I have unlimited reward and I don't get capped to the upside, right? So if the stock takes off substantially, I can keep making more and more money. A butterfly is more of a defined move similar to a debit spread, but the risk to reward ratio is a little better. The probability of profit's a little worse, and the stock does need to make a bigger move before the strategy is profitable. So that's kind of how you think about these types of strategies. There's a lot to kind of consider on each one. There are plenty of pros and cons on each one. So it's really important to understand kind of what the different trade-offs, how much potential risk and reward that you have. And using a tool like OptionsPlay allows you to truly understand your max risk, max gain, your probability of profit, and comparing the strategies side by side, and then using the P&L simulator and seeing how does each strategy perform if the stock moves higher, if it moves lower, and seeing how much profit that you can see. And also, it's important to understand how time affects the strategy, because as you can see, if the stock goes up to 180 by next week, the butterfly actually shows you very little profit, only 32% profit. You really have to hold this to expiration. And as you can see, most of the profits are made in the last few days as you hold it to expiration. So sometimes the stock can move up to 180, maybe in the next few days. And then by the time, as you get closer and closer to expiration, the stock keeps drifting higher and higher. As you can see, as you start to see, the butterfly will start to lose money. So this is really where you have to be threading the needle when it comes to butterflies. It's not this magic strategy that allows you to get this explosive amount of leverage with very little risk. There are some significant trade-offs with this type of strategy. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of how to use leverage, in your account using options, but do so in a way with limited risk, and giving you just scratching the surface as to just how creative you can get, right? Can you turn this, condor, this debit spread into something more creative? Can you sell two contracts of this and then buy, a really far out of the money call option as well, right? This is what we call a broken wing butterfly. There's so many variations that you can do on this so that you don't have you don't have losses to the upside versus a butterfly. As you can see, at some point you have losses to the upside. So what I can do is I can increase the premium that I pay in exchange for, and this is not a good example. But if I go further out in time, as you can see, what I can do is I can reduce my risk a little bit more, but I can further reduce the amount of capital that I have to pay. And I'm not making a fair comparison because I'm not using the same expiration date. But let me just do this, for example. As you can see, my max risk is substantially higher now, and my cost is substantially lower now. So there's just a lot of different ways that you can play around with this and try out different techniques to see where you can maximize your gains and losses on these types of strategies. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, feel free to type them into the Q&A section, and I'll try to answer as many questions as I have time for here today. How would you reconcile volatility outlook and trade choice? So here's the thing, right? Volatility, you should always use, this is one thing I always teach, right? Direction, which is delta, always has far more impact on your bottom line. Look at how big the swings in this and the numbers look like in terms of your P&L, and even just a small move in the underlying stock. Versus changes in Vega or changes in volatilities, you can see they certainly have an effect, but they don't turn typically your trades from profits to losses. They turn your trades from maybe a big profit to a slightly bigger profit, or a small profit to a slightly smaller profit. They're not game changers, right? Versus a small change in price drastically changes your P&L. So while you should be aware of volatility and how it affects your options positions, it should not be the sole deciding factor. You should far more be concerned about directional view. And then within directional view, you might say to yourself, based on volatility outlook, maybe shorted dated options are extremely elevated right now, so it's better for me to trade a time spread like a diagonal, versus if the two expirations are relatively similar, then maybe I might just buy a debit spread because they're easier to manage. So, use volatility to help you adjust, to make minor adjustments, but you should never say, oh, volatility is high, let me sell a credit spread, and not look at direction first. So that's my take on that. How would you choose the month to go out? Why November and not January or December? So that comes down to, again, looking at that. This is really where it does come down to volatility outlook, right? So, we're just using November as an example, but if you're going to go out to, let's say, January, right, then it doesn't make sense for you to trade a debit spread, because selling a January, let's say a 180 call or a 190 call, the problem with the January call option is that you're collecting so little premium per day. So, this is really where it makes sense to use a time spread instead. So if I look at trading this if I'm looking at this January 170, 190 call spread, I'm collecting $1.92 for the January 190s. Instead, what you should be looking at probably is something like a call vertical. Let's go out to January. We'll still buy the 175s, but what we'll do is we'll sell, let's say on October 15th, 180. So this is really where, as you can see here, in January, between now and January, which is 141 days away, I'm only going to collect $1.92, right? So if you go all the way out to January, trading a debit spread is not ideal. You're better off selling the October 180s, collecting $1.25, because I'm going to be able to collect $1.25 in just 43 days. So if I replicate that even just twice, and I have plenty of time to replicate this almost 4 times over between now and the January expiration. If I was able to collect $1.25 4 times over, that is a total premium of $6 in premium. That is going to offset almost 100% of the cost of the January 140 calls. Versus if you traded a debit spread, you're only offsetting $1.92 of that premium. And this is really where time spreads come into play, right? You can collect significantly more premium selling shorter dated options than you can do one longer dated option. So that's how you can think about choosing months. I'm just using November's as a starting point because most traders are looking out ahead 1 to 2 months from expiration. So on the leverage aspect, you're better off buying more contracts of a debit spread versus buying a call, assuming the same amount of risk. So I would generally agree with that statement. From my perspective, I would prefer to buy more contracts of a debit spread, unless I think the stock is going to make a big move on a catalyst and I don't want to limit my upside, right? So you have to think about what your objective is. If your objective is to maximize upside because maybe there's a catalyst coming up and you think the stock can really take off, right? And we've seen some stocks take off on earnings. If that's the case, you're probably better off buying a call option than buying a debit spread. But if you think the move is more defined, then yes, I would tend to agree. I tend to prefer to trade more contracts of a debit spread than fewer contracts of a call option. How about a risk reversal compared to a standard vertical? So a risk reversal, if you're talking about a call spread risk reversal, is just another variation of this, right? This is, again, getting creative, which is what you're doing here is you're buying this November 175, 180 call spread. But what I'm going to do in addition to that is I'm going to sell a call option. Let's say I sell a lower call option, let's say a 165 call option, put option, sorry, and collect another $2.08. So I'm further reducing the cost of this trade down to $1.33. So this is another way, another adjustment that you can make. But this adjustment comes with substantially more risk, right? Because now by selling that put, you are taking on risk to buy the stock at 165 and the stock keeps going lower and lower and lower. You'll keep losing more money. And you're going to need $16,633 in margin to initiate this trade. So you also significantly increase the cost of being in this particular trade. So you kind of lose that capital efficiency, you lose that leverage when you turn it into a call spread risk reversal. So Mike, hopefully that answered your question. Why did you choose the last week of the month for monthlies and not the third week? I'm not sure what you mean by the last week of the month for monthlies. The monthlies are only the third week of the month. Nan is saying, what is the strategy for market flash crash and how to overcome that big fear mentality? Flash crash means the single stock drops 5% or more in hours in 2 to 3 days, such as NVIDIA. What is the strategy? Well, the strategy is to use limited risk strategies like options. So no matter what happens, even if the stock drops 20%, in this particular case, I've only risked 0.67%. Even the maximum call option, I'm only risking 3%. So if this stock drops 50%, I'm only risking 3%. That's the whole point of these strategy sessions, is to show you how you can access leverage without taking on that downside risk. If you buy the stock, you are taking on that downside risk. So the best way to protect yourself is to use options, in my opinion. When would you use a broken wing butterfly? A broken wing butterfly is just to protect you from losing more money if the stock really takes off. So you would use a broken wing butterfly if, let's say, there's an earnings catalyst or some kind of catalyst where you are concerned that the stock can take off. In most other cases, you don't necessarily need to use a broken wing butterfly. How often do you buy butterflies? I would say fairly rarely do I buy butterflies because, again, you're trying to just thread the needle, right? I tend to find that threading the needle is not something that I'm in the business of doing. Perhaps if you're trying to trade a trading range, a well-established trading range, and you think the stock's going to return back to the top of the range or bottom of the range, and you have a very good sense for what that range is going to be. But the problem is that not only do you have to get the price right, you also have to get the timing right. And those two things are pretty hard to do in terms of threading the needle. So for those reasons, that's why I don't trade butterflies too often. If the butterfly is going wrong because of time, can we reduce the risk without getting completely out of the trade? If the butterfly is going wrong because of time, I don't know what you mean by the butterfly is going wrong because of the time. The butterfly is really only going wrong because of the price, right? Because the butterfly doesn't really have a lot of time decay because you're short two legs and you're long two legs. They largely offset each other. So, I think what you mean is you get the direction wrong. I'd have to think about that. I'm sure there are adjustments that you can make but I would say less so on the butterfly than they are on the iron condor, because you bring them closer. You can't really bring them wider apart and turn it into a condor. I'll have to think about that a little bit more. But I think there may be some adjustments that you can make, but I don't think they're necessarily great adjustments. When you roll a bull put spread further out, what is the best way to do the math for debit and credit? Same strikes, just further out. So whenever you're rolling any type of spread, a lot of people like to think about, what do I currently have? It's going to affect what I should adjust it to. You should never think of them as interlinked trades. They're not. Whenever you're rolling a trade, think of it as first you're closing a position and then you're opening a brand new position. The closed position should not influence what you do with the new position. If it's influencing your new position, then that probably means that you're not getting into an optimized spread. And if you're not getting into an optimized spread, why are you making the adjustment? So whenever you make an adjustment, you should always close out the position and assume that you're opening a brand new position as if you're not closing an existing position. Because every single time you enter a trade, you should only enter an optimized spread. And an optimized spread is based on the current price of the stock, not based on how much money you made or lost in the last trade. I hope that makes sense, because when you make trades based on how much you've made or lost in the previous trade, you're likely going to enter a spread that's not optimized. That's going to reduce your chances of potentially profiting on the next trade. And that is not a position you should ever put yourself into. So if you're ever making the decision to adjust a trade, you should always place the trade based on the current price of the stock and then not based on whether you've made or lost money on the previous trade. What about selling a call or a put with the same strike? So that's selling of straddle. I would say that that's not really using leverage, because it takes a lot of cash to sell a straddle. And you are basically trying to take a short volatility, short theta play that's delta neutral at first, but it could really start to hurt you if the stock starts to drift higher or lower. So completely different strategy than what we're discussing here. Can you do a more detailed session on butterflies? I will say I've covered everything that I really need to just explain about butterflies. They are really should only be used as a directional strategy, not as a neutral strategy. They are good for a really strong risk to reward, but low probability of profit trade. You're kind of really threading the needle here. I don't think it's suitable for most cases, because most people cannot say, I think the stock will be at this price on this date. Unless you have some magic tool that can tell you what a price will be on a specific date, I don't think butterflies specifically are very suitable for trading. I know some people like to use open interest and determine where they think the stock is going to land up on expiration date. That is something that I see investors do. But that's something that usually has a very low probability of success. So in this strategy reflects that low probability of success. But if when you do get it right, you can really make, a very strong risk to reward, but your chances of getting it right are fairly low. Should a condor be made with all calls? No, I generally tend to find that condors are really the true neutral strategy, and those should be a iron condor. Puts on the downside, calls on the upside. Are you suggesting we roll the short October 180s if it's at the money on October 15th? Yes. So whenever you're trading a time spread, whenever you're trading a time spread, you want to roll your call option. The goal is to keep rolling and keep bringing premium to offset the cost of that long call. If you can bring the cost of that long call down to as close to zero as possible, you effectively have a free bullish or bearish bet on the underlying stock. So that's the goal with the diagonal spreads. Do you have a debit spread report similar to credit spread report? No, we do not. And the reason for this is because debit spreads are only suitable for when you expect the stock is going to make a big move. Credit spreads are suitable for pretty much any time you have a general directional view, right? So for example, as you can see, this stock has been drifting higher for a long period of time. Pretty much anywhere along this drift, right, is you can potentially sell a credit spread. But guess what? None of these positions were particularly good for debit spreads. I mean, I would say the only one is if you were able to buy here and roughly sell up here, right? So out of this entire chart, there was only a single entry opportunity and largely a single exit opportunity. So we can't just scan for cheap debit spreads, because just because there's a cheap debit spread does not mean the timing on it is right. Because if you got it wrong by just a few days, if let's say you entered here and exited here, guess what? You probably would have lost money on the debit spread. So debit spreads are far more time sensitive to timing. So that's why debit spreads are more handpicked rather than credit spreads that you can scan, for optimal credit spreads and kind of sell them in many particular instances. Do you try to buy spreads at the money strikes? I'm not sure what you mean by buy spreads at the money strikes. We're looking at buying an at the money call. The debit spread is using an at the money strike. So these are all using at the money strikes for the long leg. If a butterfly gaps down, would closing the short calls and playing for a bounce back up on the exit trade an okay strategy? Sure. Yes, absolutely. If you buy a call, I guess that's one adjustment that you can make with the butterfly, right? Someone is saying if the butterfly doesn't work out, basically, in this particular case, if let's say the stock drops from 170 to 168, right? What you can do is you can buy back the 180 calls. You can sell the 185 calls, which at this point will be basically worthless. You don't have to, you can collect a little bit of premium for that. You'll be able to buy these back for next to nothing, and you'll own the 175 calls for a relatively cheap price. And if the stock bounces back up, you have a relatively low break-even price in order to be profitable. So yes, that is, I think, in my opinion, a potentially suitable adjustment for a credit spread. I mean, a butterfly. How is POP and POW calculated? POP and POW is actually fairly simple. We're just looking at the break-even price, and what we do is we apply a binomial tree to project out into the future. What is the probability of a stock being at a specific price? We use implied volatility to calculate that. And once we have that distribution tree, we're able to calculate roughly what the probability of the stock being above or below any specific price sometime in the future. It's basically how we back into the potential price of an option when we look at the probabilities in the future. So with that covers what I wanted to share with you here today. I really hope that this was helpful in giving you a better understanding as to some of the other strategies that you can use to trade, options with leverage but limited risk, and protect yourself against that, as someone called it, the flash crash, fear, right? We've seen some flash crashes. We've seen events come out of the blue that are completely out of your control, like Wells Fargo and the SEC decision that happened earlier this week. How do you protect yourself? It's using limited risk strategies like this. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here tomorrow morning on our next rapid fire session. We again have taken your feedback and and change the format of the rapid fire session. So we'll be going deeper into the bench and pulling symbols that only we think are interesting, and hopefully get to more symbols that you guys submit each week. Thank you so much, and I hope you guys have a great trading day.